Candlesticks and patterns can give another clue that traders are reacting to a predetermined supply or demand level. They should not be used alone, but in conjunction or confluence with other technical factors. Now, there's folks that are out here that that's all they do is candlesticks. They can name every single type of candlestick and every single type of pattern. That's not what we do. You'll simply hear me a lot of times just say a bullish or a bearish candle at support or resistance. Okay, they're more powerful when you use them on the higher degree time frames, and I'll show an example of that in just a moment on the euro of a very bullish monthly candle close that we had last month that led into some rallies here in the shorter term time frames as well. All right, some candlesticks that we'll look for in patterns include like pin bars, railroad tracks, outside bars, inside bars, morning stars, evening stars. Those are pretty much, everybody pretty much knows those types of patterns, or they're the most common patterns, I should say. But like I said, there's all kinds of names for all kinds of different patterns. It's just, to me, it gets really confusing. But I'm sure what I do gets confusing to some folks that maybe see candlesticks very well. And this all gets back to, what do you see well? What comes easy for you? Okay. Now, candlesticks and candle patterns only have meaning when they occur after a strong run in price, not in a choppy consolidating market. If traders are just chopping wood, we're just moving sideways, candlesticks mean absolutely nothing. Okay, so let's go ahead and just pull up a chart here, and we'll go ahead and have a look at some candles here. I'm just going to use a recent chart here again. Here's this euro dollar. And you can see, like right in here at the end, when we had this divergence coming up, we had price moving higher, MACD swinging lower. This is a very bearish candle right here. And I guess this would be considered an outside bar, since it encompassed, let's see, 1, 2, 3, 4, 5, 6 bars in its close. Okay, I think that's called an outside bar. To me, it's a bearish candle. All right, so we had divergence. We were looking for price to come into this area and react, and then we had this very bearish candle that encompassed all of these previous candles and closed. Okay, that's bearish. That's bearish. And just let me go ahead and just draw a little ellipse on this right here so we can make sure everybody sees it right there. Okay, and that set off this corrective cycle. Then again, right here, as we came down to test, this support level right here at the end of a double correction, we had another candle. Actually, both of these candles right here, both of these candles indicate a potential turn. One of them is called, I believe, a hanging man, the first candle here, the red one, and then the green one obviously is an inverted hammer. Everybody's pretty familiar with that. But here you have two candles in a row that are signaling a potential turn in price, right at the end of a correction, and it was at this support level, okay, previous support level, at the end of a run, okay, at the end of a run, which made it more significant. Okay, then we saw a turn and a continued rally. Okay, at the end of this run, where this divergence is right here, see how we had this bullish candle made a new high, price moving higher, MACD swinging lower, and look at the next candle. Right at the close of this candle immediately took off and closed below the low of this candle. So price came up, we had a divergence, we were looking for price to react, then we had an immediate, right after this candle closed, we had an immediate decline and it closed below that candle. Okay, to me, that's a bearish candle. That's a bearish look. Now, I'm not sure if this will be categorized as an outside bar or anything, but to me, it's a bearish candle and it would be significant. Okay, we'll back up a little bit here, and looking at right here before we let into this correction, price rallied. Okay, strong bearish candle led into a three-wave corrective cycle. Let's go ahead and have a look here at the monthly chart on the euro, and you can see I have this chart already pulled up. That's pretty significant right there. That's pretty significant. This is some monthly support, monthly swing lows. You could also see we're right here. We just came through the 62% Fibonacci retracement. This right here is called a railroad track. Okay, and on a monthly time frame can be very significant. Okay, let's just go ahead and draw a little circle so everybody sees this. Okay, this is a railroad track and can be very significant on a monthly time frame. We can already see price pulled back a little bit and continued higher. So on intraday time frames, that was already significant for a bit of a rally here this month. Over here, we have what is called a morning star pattern. I'll just highlight this. This is a morning star. See how price declined more. We had a doji. Get a doji develop here, and then a very bullish rally that closed almost all the way near the top of the candle here. So this is an example of what's called a morning star. Here's another outside bar that signaled the beginning of this down cycle. Price came up on a significant run. Then we had the next candle opened up and just straight down and closed very bearish. The close encompassed the previous two candles. All right, another run up in price right here. Moved into a retracement level, and this is called a hammer. Let me just highlight that so you can kind of get an idea of what you're looking for. Okay, when you're looking for candle patterns here. Okay, again, I'm not a big candlestick trader or candle pattern trader, but you will hear me mention the bullish or bearish candles at key levels, especially on the higher time frames. And we'll also, again, talk about a more aggressive entry strategy for the divergence setup that uses candlesticks for those of you who do like to use candlesticks for trade entries.